Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it.
Kia ora and welcome back to Markets, Mystics and Mayhem. In today's episode, we're going to be talking about mortgage refixing and what the New Zealand mortgage book looks like. It's shortened up, which does mean that rate cuts that the Reserve Bank has been delivering should feed through to the economy much faster than previous, cutting cycles. That does mean that the rebound in the New Zealand economy should come faster in the second half of this year. So we do expect a sort of cyclical rebound in economic growth this year. But looking beyond that, there are some factors out there that kind of inhibit future growth. And Reserve Bank Chief Economist Paul Conway kind of touched on these things in a speech he delivered recently. So we're going to delve into that. But why don't we start first with the mortgage book? JK, you've been looking at the data and you've seen kind of what the New Zealand mortgage book looks like. Tell us about it.
Yeah, you're right. So Kiwis love to fix a mortgage like most people around the world, excluding Australians. They like floating for some reason, just leave them to it. But yeah, no, we like fixed rates. There was a lot of volatility in the 90s that got people onto fixed rates. And we sort of, the length that we fix changes over time. And what we've seen recently is that most people are fixing for much shorter tenors. So like 6 months as being probably the most popular rate at the moment, which is great because when the Reserve Bank cuts, it feeds through the mortgage book much faster when people are fixed for short term. So as you say, the rate cuts that were delivered last year feeding through now and, should lead to a bounce back in growth later in this year.
Yeah. And you said it's like 80% of the book, right? That's either on floating or fixed for less than a year.
Yeah. So of the mortgage book, not just Kiwibank's mortgage book, but the whole mortgage book throughout New Zealand. So it includes those 4 Australian Teletubbies. 80%, over 80% fixed for less than a year. So that's great. Things are feeding through fast. That changes. So you go back to before the GFC and only, 40% of people were fixed for less than a year. Most people wanted that 2-3 year rate. They wanted to lock it in for a long time. They learnt the hard way that hurts in a downturn. So the RBNZ was forced to cut very aggressively in 2008 all the way through 2009. They cut the cash rate from 8.25 down to 2.5, but people on a 2-year fixed rate were stuck. And it took ages, and it was frustrating from the Reserve Bank's perspective too. It took a long time for these cuts to feed through. Now that's not a problem.
It is interesting to see that, how we've kind of broken precedent there and we've just seen this mad rush to the floating and the short-term rates. And actually, I think most of the growth, it's an increasing proportion going on to the floating rates, right? And it's a gamble because these shorter rates, so shorter-term rates are higher than the 2-year rates or 5-year rates.
Yeah, I was just going to say that it's interesting to see people have kind of learnt from their lessons from the GFC. And now I think there's also we're starting to get a lot of questions about when the right time. We've seen the shortening in the book, but now the discussion is going on when do we outstretch our mortgage and fix back to these 1 year, 2 year? I mean, I think it definitely helps that you have a lot of economists out there being very vocal about how much more rate cuts are coming. We've always said 125 basis points more from the Reserve Bank. But that question is definitely growing. I know we're getting asked it internally, externally by media. So, yeah, I think, what do we have to say about that?
Yeah, it is. I mean, I was at a real estate conference just last week and got asked that question quite a lot. When do we start looking at the 2-year plus rates? And the answer is not yet. In my opinion, I think we've got to see the rate cuts coming through, and then economists like us calling the end of the cutting cycle that'll sort of coincide with people going, okay, there's no more rate cuts. I'm not taking a bet with a 6-month rate now. I'll look at that 2-year rate, which will probably be one of the more attractive rates on the curve anyway, and they'll push out.
But going back to like the short term now, so with households fixed on about 80% of households fixed on 1 year or less, I guess, can we officially say that, how we normally say monetary policy works with these 18 to 24 month lags? Can we basically say monetary policy now is pretty much going to work with a maybe 6 to 12 month lag instead?
I think that's exactly what we're saying. So, traditionally the Reserve Bank has been out there saying it takes 18 months plus for everything to feed through. But if everyone's fixed on, 80% of people are fixed on a 6-month rate, it feeds through faster.
Yeah, again, it's that if we look back, that lag was very much because of previous cutting cycles where it was very long. That transmission took some time, but this year, second half, we should see the rate cuts feed through, and that should mean more disposable incomes for households, and we should see growth in that going into 2026.
And the next discussion we will have on our trading floor, talking to, say, Belinda Newman, our treasurer, or some of our financial markets traders, is going to be, what does this do to wholesale rates? So when people are fixing for 6 months, we've got offsetting term deposits, around the same time. So we don't need to hedge that 6-month rate, but we do need to hedge a 2-year rate. And to hedge a 2-year rate, that's basically an economist saying that we go out and into the wholesale market and fix a 2-year rate. So we pay the 2-year fixed swap rate when we get that flow. What that does is you have banks positioning the same way, and that can actually force the wholesale interest rate market up on the back of bank fixing alone. We've seen it plenty of times in the past. That'll be interesting, I think, because not only will interest rates, bottoms, but we'll see, I think, those wholesale rates push on the back of some of this mortgage fixing that pushes out.
So again, maybe that's why that 2-year rate will be the more attractive one rather than going all the way out to 5 year. I mean, historically, we don't really play around in that 5-year space. I think it's when rates went down to their very lowest, that's when people were starting to get a little bit, having a little bit more fun with breaking up their mortgage. But again, that 2-year rate is the favoured space, isn't it?
Yeah. I proudly took a 5-year rate in 2021, which doesn't come off until 26. So loving that. But I wish I'd done the whole mortgage, not just a little bit of it. All right, we're talking about the bounce back in growth in our forecast. Why don't you tell us, what's happening near term and medium term?
Yeah, well, precisely because this transmission seems, shorter than previous cycles, we are expecting growth to pick up from the second half of this year. That sort of cyclical rebound. We've gone through quite a few cycles in the last 5 years, honestly. But yeah, we're expecting that growth to pick up as households, have rate cuts and there's more disposable income for them to spend more, and also for businesses, they can actually start to look to 2026 and invest more. So all those components of economic activity should start to pick up. And that's why we see this rebound in economic growth. Beyond that, though, that potential growth output, that outlook for that, there are some sort of structural forces out there that does inhibit, growth of beyond 3% on a long-term basis. And this is something that Conway touched on in his speech, didn't he?
Yeah, it was a really interesting speech. Very sobering, but I think good for us to hear, and probably something that, we in the industry do know already, but just how, even though we're expecting this recovery, as you said, the potential for more growth without sort of triggering higher inflation is actually limited because of mainly our sort of productivity declines, and also just the way we approach growth in New Zealand here, which is very labor driven. So when we think of, okay, let's put more output out there, what do? We chuck more labor at it, more people, more hours. We're essentially working harder and not smarter. We're pretty much a bit slow to adopt faster, smarter technologies to help us with things. Yeah, part of that is our sort of geographical isolation. We are physically isolated from the rest of the world, which means we don't really tend to have the same speed of adoption of these technologies, but it's still really no excuse, and it is sort of an area that we need to really invest in. And speaking of investment, that is kind of the way out of this sort of slump. For too long we have sort of over-invested in housing, which we know is an unproductive asset. But, what about our businesses? What about, New Zealand equity market, research and development, education, things like that. So we're really in a bit of a slumpy point going forward.
And it's interesting because I think our long-standing reliance on labour was really highlighted during COVID. We shut down the borders, and a lot of, companies, organisations, they stood still in terms of output. And there was a slight increase actually in, I think, a survey that showed that investment in labour-saving technology was starting to rise. So there was some, glimpses of hope that we'd see a change in the way that we view growth, but that was short-lived. We opened the borders and, migrants came flowing through, and again, we're dependent on that kind of labour to see growth in the future.
Exactly. And what happens once that labour doesn't come in anymore, right? Like right now we're seeing net migration cooling because the labour market's not doing too good. That's just going to exacerbate things further.
I like your point about investment. That's the key, right? You've got to invest in, like you said, education, research. We need to invest in our infrastructure. That's been a real bugbear of mine for a long time, is this underinvestment. And it really is inhibiting our productivity, which is, the output per worker that you're talking about. To be fair though, a lot of our, big industries are very labour intensive, whether it's agri or, tourism and that sort of stuff. But that can get better over time.
Yeah, Australia's mining industry apparently is facing an unknown future around AI, potentially using AI, which is obviously
in mining
in Australia. Yeah, that's
incredible what they can do. Well, when I was living there, this is while I was living there, 10 plus years ago, Rio put all of their trucks on automated, those massive yellow Caterpillar trucks that basically go around in circles all day. They took the drivers out, made them driverless. They look at it all through the Perth airport, runs it. And these trucks just go around, and they had an immediate increase in productivity of 12% by taking the humans out, the human error, the fact that you have to stop every 8 hours for a break or whatever it is. That's just...
Maybe that means we see more Kiwi stay.
Yeah, potentially.
They don't go over the ditch.
And the other thing that we're kind of lacking here in New Zealand is that we don't have very deep capital markets, was the other main point. So, how do we even go about addressing that, though, is my question, right?
It saddens me, to be fair. It's very hard for businesses to get, venture capital, that seed capital and money as you go along. And a lot of it is tied to a house. If you're in that SME space, you go to a bank, you link it to your house, which is obviously pretty good collateral, and away you go. But it would be nice if there were more, angel investors and that sort of stuff.
Okay, so Jarrod, what would you do to boost New Zealand productivity?
I'd do a lot more around getting the right minds in the right room with the right time horizon. So I keep thinking of NZ Super as like a beautiful example of setting something up with a long time horizon. So there's no drawdowns in NZ Super until the mid-2030s. So they've got a long-term investment horizon full of smart people, like super smart people with a long-term objective. If we had something like that for infrastructure where you empower the councils rather than inhibit them, you give funding for a long period of time and long horizons, not 3 yearly election cycles, but actually, Auckland needs, train, rails, whatever it is, and deliver it over a long period of time. Because when you give people long time horizons, they can gear up. So if you give a builder, 10 years worth of work, he or she will leverage up and deliver. We need that leveraging up in New Zealand. We're full of small builders and small contractors, but we need more, larger, longer term focused entities.
Yeah, and I think that's just logical because these big infrastructure projects, they're by definition multi-year. They go well beyond election cycles. You need that kind of unit to see these, these infrastructure projects go from blueprint to actually completed.
Yeah, and we need to think, beyond the past generation, right? We're sitting here complaining about the last generation not investing enough. We need to be looking to not just the next generation, but the generation after that. They do that well in other countries, but we don't seem to do it. And I think the Auckland Harbour Bridge is a classic example of you build something for what you think you need now, and then in less than 10 years, you're having to put clip-ons on it because you didn't build it big enough to start with. And then you've done nothing to it since. No tunnel, no extra thing. Go to Sydney, look at their harbour bridge, look at the tunnel that they got going under it. You can't tell me Australians are smarter than us. I just won't believe it. So what else did Paul Conway say?
Yeah, I mean, I guess on the note of improving our sort of interconnectivity, is that even the right word?
You're an economist, you're allowed to make up words.
But I mean, I think as our trade and our exports, they're not everything when it comes to productivity, but I mean, you can't deny the fact that we are very not diversified in our trade and that we need to expand there. We've got mainly all of our traders for China, they're our largest trading partner, then it's Australia. But, what about India, as we always talk about? What about all these other sort of Asian countries that we could be expanding to? And, what are the benefits that we could have there if we had stronger trade connections? China's starting to come out with their own AI sort of software, as we've seen recently. It's good that China's got that, but maybe India will be next, and we need to have these sort of relationships established to get us in and have our foot in the door, I guess.
Yeah, we definitely need to diversify our trading partners. Absolutely. India is probably top of the list for me. Then there's places like Vietnam. Talking to Kiwibank's CFO this morning, just got back from Vietnam, talking about how the middle class is, growing at a rapid rate, and I think he said there's 100 million people there, so not a small economy. There's lots throughout Asia. I think we could be tapping into, Philippines, elsewhere.
Yeah, we're export-led nation, so we should take advantage of that and open up and tap into other markets out there, not only for us to benefit in terms of trade, but also that technology aspect of it, open up, learn from other countries and how they're adopting and adapting to new challenges that we always face.
MJ, final tip on productivity then.
I think those are the main ones.
We're researchers. You got to put more money into research.
Yeah, actually, yes. The research and development side of things. I think that's a real segment of the economy that you can.
Where'd you get that idea from?
Huh? My research. But that's also good. I think just what Conway said, I think the best way to kind of explain or describe our current situation is that New Zealand is a small, distant, capital, shallow economy, and for us to be more productive, it's about changing all those things. You can't change necessarily how small or isolated we are, but you can definitely mitigate that or try and improve our position globally. Because right now, all the charts he showed are pretty depressing in terms of our standing internationally.
Which we'll put in the podcast and notes for anyone interested.
I guess that's it for this week's episode. Interesting to see how we'll be keeping an eye on rate cuts and how the mortgage book changes. But, we're casting our eye also into the New Zealand economy beyond 2025. And obviously there are some challenges out there that we need to research into and look at how to solve those things. So tune in next week.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.